Hi, welcome to the Federal. I'm Harish Upadhyay. Food aggregator Zomato's IPO has got a blockbuster subscription and has been oversubscribed 38 times. They've received bids worth around 2 trillion. So why is this demand coming in? Is this a really good value stock, or is it just some pure liquidity and trading craze that's really resulting in this kind of oversubscription? Many independent analysts who've gone through the final details and numbers of Zomato say perhaps there might not be much in terms of revenue growth and other details that have been put out in the public domain that indicates that this will be a value stock. Well, one of them is Anurag Singh. He's a SEBI registered independent analyst. He also runs a hedge fund, a privately held hedge fund in the United States. Well, welcome to the show, Anurag.
Thank you. Thanks, Harish. Pleasure being here.
Anurag, the first question that everyone has on their mind is the Zomato stock really a value stock, or is it just some liquidity and trading craze that's drawing this kind of a subscription for an IPO?
Yeah. So look, Harish, in classic terms, it's so there are two kind of categories. There is a value investing school of thought, and there is a growth investing. So it's certainly nobody is saying that it's a value stock in that sense. People are calling it a growth story, and that's where it is being categorized. But I think it's a growth stock with a twist, and I think that's where people will have to understand the context of the kind of IPOs that are coming in the country, and I think everybody needs to understand it. One is that gone are the days where, for example, TCS listed in 2004 at a price earning ratio of 23, and they were being generous because they said, look, Infosys is at 32, we got to price us a bit lower. The company was making money. Same goes for companies like Kotak Bank, HDFC, and a lot of these companies that got listed in 90s and 2000s, right? That was a time when companies were making profits, and SEBI was very particular that will not allow loss-making companies to get listed. I think since 2015 onwards, SEBI has changed the guidelines on this, and what's now happening is that these companies which are venture capital funded are still making losses, are allowed to list. Now, that IPO, the meaning of an IPO here changes, because initial public offering is when a company is growing, they need money, and they could go to the market to raise capital. Now that's when the company is also in need of the capital, and the market needs money to invest in, and it's a kind of a perfect match. And that's how some of these growth companies in India have kind of been born in the last 20 years, and they've given good yield to the investors. Out here, the story is very different. Companies don't need money to grow. When they need it, they have the advantage of timing it well. They want to time it when the market is flushed with liquidity, and they can get the right price and the return on investment. Second is there's a bit of an information asymmetry. Like, they have all the information. They've been industry company insiders for the last 4, 5 years, 7 years. They know everything about the company, and investors actually know nothing. So that's the second advantage they have. And the third is that when you are trying to this whole debate of this brick and mortar old school companies, and this is a new age technology company. I think this debate is bogus, because at the end of it, no matter what you say, you need to buy companies which are eventually going to make money, because that's what the stock is. Stock is your share in the company, and nobody wants to invest in a share which keeps making losses, so you keep putting more capital. So I think these things are pretty fundamental, and investors need to understand that they should not confuse these IPOs with Infosys IPO or TCS IPO or HDFC Bank IPO. These are very different IPOs. Somebody has already joined the party much earlier than you. They know all the details of the company, and then they are now trying to hand over to you, saying that, hey, there's going to be another party. But I doubt that's going to happen. And that's what we have seen with a lot of these companies, be it in US, and we'll see that in India as well. Harish?
True. Well, you were talking about, these investors knowing the nitty-gritties, the finer numbers, and the finer details of the whole business. Now coming to Zomato, you've written quite a bit on that. What does the valuation say, or even the net worth? One aspect that traditional investors, perhaps in the last decade, would look at is how transparent is a company with their numbers and accounting practices. How do you look at the net worth and the valuation of Zomato? Has it been consistent? Anything that really stands out, was it?
Yeah, so that's a good question, Harish, and I think that's where at some point investors will need to say, hey, look, I understand all of this, but tell me what's the real story. Tell me what is the numbers, and that's where I think the story deepens a bit more. So when I'm saying there is an information asymmetry, SEBI here doesn't have a specific format in which the information has to be disclosed. Of course, there will be a balance sheet and there'll be a P&L, and there will be a cash flow statement. But those are lumpy numbers. Below those numbers, there are numerous details. These companies have, Zomato is in 23 countries outside India, right? They claim 40 to 50% of their customer base is outside India. They provide absolutely no details around what business comes from where. So I don't know where from the user base is coming and where from the profitability is coming. So that's all lumpy numbers. So I think in absence of any formatted disclosures demanded by SEBI, it becomes very difficult and it becomes kind of a free for all for every company to kind of state the numbers the way they want to tabulate it. So that's one problem. I think let's kind of try and look at how the history of the valuation has evolved out here in case of Zomato. Now look, you look at the current ownership. I think about InfoEdge owns about 18%. 9% is owned by Uber. Then there is Ant Financial of China, Alibaba Group. They own kind of about 18-20%. So they kind of, that these investors, they're all, I think, at least stop calling it like those Indian success story, Indian investors. There's no Indian in it. The people are Indian, the business is Indian, but look, everything else is foreign money and they want to have a smart exit. So that's point number one. Second, how do they kind of, climb up the valuation ladder? Interestingly, look at Feb 2019. The same investors are investing money at a valuation of 2.8 billion. In about 12 months' time, Jan 2020 is when Uber buys a stake. Actually, Zomato buys Uber Eats. Now that happens at a valuation of $3 billion, right? 2020, and that's just before the pandemic hit us, right? So the world is hunky-dory, everything is normal. That's $3 billion valuation. That look, the company is worth that much. And that's how, the price rises by just about 40% in about couple of months. And, in another 3-4 months, they hit the market and the valuation now is $8.8 billion expected. So I think if you're looking at a rise of about, threefold, like just something like 3 billion becomes $8.8 billion in just about 18 months time frame. I don't know what has changed, if at all the market has got even worse. So I think that's the information asymmetry I'm talking about. That's the valuation ladder I'm talking about. And that's the smart exit that I'm talking about, that some of these private equity guys are trying to do. And I think eventually who will be holding the bag, so to say, it'll be all domestic investors. And that's not a smart Indian success story. I'm sure it won't count at that. And we can, Harish, if you like, we can dwell upon, what are the kind of the metrics look at for this company, like what are the sales numbers and others. But I would just pause for your reactions on this.
You spoke about the valuation. What I want to know is, since you've gone through the details, does this valuation reflect in any way, or is it in sync with their sales or growth, or the revenue that they make?
Yeah, perfect. So yeah, and that's where again I think we are hit by this kind of every company creates its own story. They create their own success metric, and they narrate they tell you the story the way they want to. But I think we have certain international benchmarks, and I think we can compare with that. But I think more importantly, let's look at the sales numbers and the orders, and then all of these metrics on a company. Eventually, what does Zomato do? It delivers food to you. It charges some cut from the people the restaurants who make the food, and then they eventually deliver it to you, and that's the service they provide, and for that they charge money. There are other business models they're trying to get into, but primarily their money comes from this. Again, we can't say, but we know its majority revenue comes from here, but then they don't feel it is necessary to disclose to the investor where the money from the 4 business verticals come from. So that's the best guess we can make now. I think if you look at sales, all they give is 2019, 2020, 2021. Sales from 2019 to 2020 grew, but from 2020 to FY21, the sales have fallen by 22%. That's the top line. Interestingly, you look at expenses, all the major expenses they have are on the sales promotion side, which is the discounts customers get. That's the major expense. They're all clubbed under other expenses, in a P&L. Now, these other expenses surprisingly dropped by 62% compared to last year. Now, your sales is dropping by 20%, and I understand you have reasons of COVID and other reasons. But how can other expenses drop by 62%? Now, that's, classic window dressing, right? And you try and search through the document, you don't find, because a lot of companies can capitalize these advertising promotion expenses, and then eventually they can, write them, amortize them at later stages. But what it does is it gives you initial kick. So this sudden 60% drop in expenses, suddenly reduces the losses for the company for this year. And this is so convenient because, look, they got to list here, right? So, I'm not surprised. If you look at some of the other metrics, we try and look at, their number of active users, right? That has dropped from 42 million to 32 million. Again, as I said, it's notable. 50% of them are outside India. I don't know how profitable they are, but that's the story. Their order size is dropping. They're very ambiguous about their order size. They don't even state the order size. But in one of the interviews, the CEO says that, their order size has dropped. Although this is pretty ambiguous in their report, and they don't disclose that very clearly. So I think those are, Harish, some of the metrics I would say that which kind of raise questions. There are 2 very significant points I want to call out here. And I think, look, users, your viewers can decide what it is. They changed their accounting policy mid of 2019. So October 2019, so we're given 3 years financial. Right in the mid October 2019 is when they changed their revenue recognition policy. So earlier they were saying, now we are a service provider. We take a cut from the restaurant, and we deduct the discounts from it, and that's our revenue. 2019 October, they say, no, this is not our revenue. Our revenue is, we are a pure tech platform. We charge service fee for that. Now, take it the way you want. But here is what an analyst would say. You change your accounting policy and revenue recognition, but give me the restated numbers in the old policy and as well as in the new accounting policy. That surprisingly is missing. And I think a lot of my other good friends have raised this question as well, that look, the company in good faith should have reinstated the sales and the P&L numbers, both in the new accounting policy and the old accounting policy. And that's where I also raise questions that some of these, SEBI has allowed this free run to the companies to state the numbers they want to, and they just kind of confuse people. Now, there's no way that I can compare your FY20 sales with FY21 sales. They've fallen by 22%, but for all we know, they might be, kind of more devil in the details. So Harish, I think these numbers don't make us comfortable. And I think I don't think that your kind of readers have any wherewithal.
Any company in the run-up to IPO makes certain changes to its processes to adhere to few norms or even to make it transparent. We are seeing LIC also fixing several of their processes, administration, just to ensure that they're transparent once they go in for the IPO. Would you see some of the changes that Zomato has done in the accounting process, how they've accounted certain expenses under different heads? Would it come under that, since you've seen so many companies and their IPOs? Or do you think this is pure play window dressing that's happening just to ensure that the losses come down?
Yes. So Harish, interestingly, look at this calculation called earning per share. Now, as I was making this point earlier, these are loss-making companies. There is, we all go by price earning multiple. We all understand it. But these loss-making companies have invented a new term, which is called price to sales. Now, I understand there's a sense to price to earning because, hey, I compare it to bond rate. And if my that's the share price I'm buying at, and if that is the profit per share per year, I calculate the yield and I understand it's profitable versus a bond, and so equity should always give me more returns. But what is this price to sales? Price to sales doesn't mean anything. It's not profit, right? So what do I do with that number? So that's kind of one call out here. Second, Harish, is if you look at earning per share, I think to your point, now sudden drop of 60% on other expenses. Now company is saying, hey, my loss per share has dropped from 5.4 rupees to 1.1 rupees compared to last year, right? Understandable. But look at the devil in the details here. The share base, which is, you're comparing everything per share, the share base has grown by 25%. So one is that dilution. What do I do with that, right? Second, you don't disclose how are you capitalizing your promotion expenses. You don't provide details. Suddenly they've fallen by 60%. But how? And you look at the cash flow statement and the numbers are pretty flimsy. I can't make out whether what is the cash flow numbers don't really commensurately match up with the P&L. And so that tells me that there is a story being hidden somewhere. The cash flow of the company is not as strong as the P&L is made out to be. And I think that's where, Harish, I think any person who understands accounting can make sense that, look, I need to know more about this. There's something being hidden, right? And well, if they don't want to disclose, that's fine. That's their call. But I'm not going to put my money behind it, right? And certainly not at 20 times price to sales. What number is that, right? And I think if you like, for your viewers, compare DoorDash.
In fact, that's where I was coming. Say people in the previous decade, or traditional investors from my father's generation, would ideally look, every time IPO launches, they would look at the numbers of that particular company with the existing company that's in the same category. Even now, if a mid-cap IT company goes for IPO, we would look at numbers, compare it to an existing listed mid-cap IT company. Obviously, we do not have probably a company in India that's in the same space and is listed. So how do you do that comparison? You were talking about a couple of options in the US.
Harish, that's another good question. I think certain old school methods really, they're kind of timeless. They hold true all the time because, as I said, eventually companies are in the business of making profits, right? So I think those P comparisons should always be done, and I think it makes good sense to do that. I think I've tried to do a comparison with DoorDash. Now look, Uber Eats is difficult because Uber is one company which is into ride hailing and everything. So they conveniently don't give breakups, but DoorDash is pretty much the same business model that Zomato is trying to replicate in India. DoorDash got listed December 2020. Again, can't be well timed. All digital companies gained during the pandemic times. Unlike in India, here the orders really skyrocketed, because deliveries were freely allowed. So it couldn't have been timed better. That company, many touted as overvalued, got listed at a valuation in December 2020. So this is about 6 months back at 62 billion. Right? That's the valuation it got listed on day one. Today, it's ruling at somewhere around 58 billion. I think the kind of, ever since its listing, it never really touched that peak again. It just kind of started the gradual recede. And I think it was expected because, again, there was nothing much left on the table for the investors. Now, Zomato still beats that hands down. I think here are certain numbers you can compare. Now, DoorDash has a revenue of 2.8 billion per year. Zomato has 0.28 billion. It's just about 280 million company, right? 1/10 of the revenues of DoorDash. Average ticket size, Harish, this is interesting. Average ticket size here in US is $33 per order. Zomato is running with the average ticket size of $4 to $5 per order, right? Gross margins, which is, after, deducting your operational costs, expenses, this is the kind of the margin that the company work with, is 52% for DoorDash, right? It's pretty smart, right? And that's how maybe it got that valuation, 52% gross margins. Zomato has a negative 23% gross margins. Now, if you can't make a gross margin positive, now what else do you expect further from a company, like Zomato? So no, what I did is eventually I said, okay, forget everything else. Assume that on today's sales, company can make a 15% net margin, which is pretty smart, by the way. It's not easy to make a 15% net margin on it. And I tried to calculate the PE. Zomato at a 15% net margin on today's sales comes to at a price earning of 143, 153. 140, 150, okay, it's overvalued, but if they double their sales, say it becomes 75 and then it becomes 40, still understandable. It leaves the things within the realm of imagination. Zomato, you assume on today's sales a net margin of 15%, the price earning ratio comes to 15,000. 15,000. So take that number, absorb it and understand, guys, the company will have to grow 10 times and you will still be nowhere in terms of your price earning multiple. So Harish, I think some of these fundamentals, I think, hold true all the time. It doesn't matter, tech or non-tech. Companies have to make profit. Valuations have to make sense. And I think I don't need to remind investors that if you buy something at a wrong price, look, be it real estate or a stock, it's not going to give you the returns, right?
True. In fact, I have just two more questions. I know we are running out of time.
Sure.
One is there's this interesting point that came out yesterday that the amount of shares that have been kept aside for the employees, only 40% of it has been subscribed. I don't know the eventual numbers that turned up post the IPO closing.
50%.
But still, the employees themselves haven't shown the kind of enthusiasm that we've seen the retail investors showing. I mean, as an investment analyst, how would you read it?
Yeah, so that's a bit of a red flag, Harish, and I'm surprised that how did this come out, and company would have tried its best to kind of control this kind of information, right? But it kind of raises a red flag, right? And I think being insiders in a company, and I know I've worked for 3-4 professional companies. I know the story the best, and I think these startups, wherever people are working, if the companies are strong, the sales are strong, people know, employees get to know the first, right? And I think if the company is struggling, the business is kind of not growing the way it was touted to be, employees are laid off, I think they get the message, right? They get everything. So I think all this accounting shenanigans that happen, which play with the earning per share, that aside, employees don't feel that, right? They feel what's happening on the ground, and I think that message is not right. When 50% of the quota got subscribed, I think that's kind of little troubling. Additionally, Harish, also it's also important. Look, when SEBI said, okay, I'm allowing loss-making companies to list, it said, look, I'm mandating that not more than 25% will be for retail and HNIs. 75% will be institutional. A lot of people are writing to me saying, hey, look, 75% are institutional investors. They should have seen through these numbers. If they are investing, what's wrong with our money? Look, the catch there is, you see the list of mutual funds that have tried to invest money there. The problem is it's eventually for them still other people's money. And yes, I understand mutual funds are ultimately responsible, but look, they have to play in the Indian market. These are the players which are coming out. There are no new IPOs coming out. If they do make something, and they got to invest in these companies. Second is there are a lot of these hidden floors which are set for investors, which you and me don't get, right? So a lot of these private equity players and a lot of these institutional investors get a floor underwritten, and they have a lot of terms at which they enter. Nobody invests big money without any guarantees of a floor rate, right? So they have certain smart exit routes in case something goes wrong, but retail investors don't have it. So I think I wouldn't be following them to this journey as a retail investor, I would say.
In fact, just to put out a clarification for our viewers, when I said Zomato employees, I was not referring to the delivery guys. There are others who are on the rolls of Zomato who can afford subscribing to these IPOs or their own company IPOs. That's what I was referring to. Finally, Anurag, as an investment analyst, what would you advise the retail investors? What to do with the stock? Should they ideally, if they get allocation, should they just cash out on the listing day? That's what many have actually subscribed for, hoping there's a big blockbuster listing that happens. But on the other hand, we've seen some IPOs that did not get oversubscribed, say 25, 30 times, like Loda or Barbecue Nation, but still doing really well, not just on the listing day, but after that as well. So
Yeah.
how do you look at this, or how do you advise the retail investors to proceed from here on?
So Harish, look, I think it has. So first of all, that's not a. I wouldn't call somebody who applies for a share just for a listing pop. That's not a smart investor, right? Anyway, so you look, you are trying to, you're trying to gamble anyways, right? You like it or not, but that's pure gambling. Second, we've seen some of these, and the last thread I got on one of the IPOs was the SBI Cards IPO, and a lot of people were there almost, oh, SBI Cards, nothing can go wrong. And look what happened. There was, forget listing pop, there was kind of a listing drop, significant listing drop, and people had to kind of sit on it for quite some time. So I think if everybody starts getting into the market thinking of a listing pop, look, listing pop doesn't happen. It's happening right here in US. A lot of people think they will sell it on day one, and it only falls from that point. So you are wiser investor only if you do your research and you play little against the herd. If you go with the herd, then you will fall with the herd. I think some of that mentality is kind of come into play here, Harish. Second is, Harish, nobody, and a lot of people have written to me, and a lot of good friends and who are HNIs and investors, a lot of institutional guys, we've exchanged views. Nobody is saying this is a sane IPO, but it is just working on a bigger fool theory. Somewhere, I don't care, I'll buy it and I'll hand over to somebody who is a bigger fool than me. Eventually, he will be holding the bag, right? But I doubt that's going to happen. I mean, we'll all watch out. We live in a very different times, right? But these kind of parties can't go on forever, right? We'll have to wait and see.
Absolutely. Well, the party is not over, but we'll have to see if this party will end on a happy note. Definitely, the IPO has gone well, but the listing and how it proceeds, how the stock proceeds after that, would really decide how this goes. Thanks a lot, Anurag, for joining us on the show and giving us some very insightful details on the whole business of Zomato, the finer details and nitty-gritties on the revenue and the growth, and what could really aid or be against the stock once it gets listed. Well, that's it in this special interview. Do tune in and also read the other stories on federal.com.